very good afternoon. You're watching Closing Trades on ET Now. I am Snevi Shah. Well, we're tracking the last lap of the market today, and it's been good so far for the market. Nothing too exciting, but nothing much to complain either when you take a look at what the markets have done. So yes, absolutely flat on the Nifty. We have been range bound ever since we touched that all-time high on the Nifty yesterday. But nothing too surprising. Sensex also absolutely flat. The India VIX has seen a cool off of about 4.5 to 5%. So that looks good for the India VIX. Nifty Bank at one point of the day was higher by about 0.2%. But there also some profit taking has been seen and some simmering down of the gains from the day's high. Absolutely flat right now with a mild hint of a positive bias for the Nifty Bank. In fact, absolutely on the flat line for that one as well. If you take a look at some of the gainers and losers from the Nifty 50 group stocks, Adani Enterprises continues to do well, about 2% higher, as is the case with M&M. Following closely is Adani Ports and Sun Pharma. On the flip side, massive pressure on Shriram Finance, 2% lower on that stock after reaching its all-time high, and very good gains in yesterday's trade. So some profit taking over there, as is the case with SBI Life, HDFC Life, Power Grid and Tata Consumer. The advance decline ratio continues to be even Steven, with a slight bias towards the declines, very nominal bias over there. Sectorally, it's been a mixed day of trade coming in because you have a mixed bag with auto, pharma, metals, PSU banks doing well, IT, FMCG and Nifty Bank on the flat line. On the flip side, slight pressure on realty, and it's the energy index that's under slight pressure today. All the losses led over there by GAIL. That massive cut that we saw on GAIL after their tariff request from PNGRB was that hike was not to the tune of what they were expecting. They were expecting a 33% hike, and PNGRB has given them a 12% hike on the tariff front. So yes, GAIL continues to be under pressure, but some recovery from the day's low for GAIL as well, because it was lower by about 5.5 to 6% at one point, but now has recovered, is trading with cuts of about 4.5%. This is what the breadth of the market is looking like. GAIL, MCX, Transformers and Rectifiers, Sirma under pressure, but on the flip side, Welspun Living is up 10.5%. You have Ipca Labs, Force Motors, Varun Beverage is doing well with a 3% uptick. But which are some stocks to watch out for, and the ones that we have been tracking very closely on the back of individual news flow? My colleague Ravinder is joining us on the show with a list of all of those buzzers. Ravinder.
Well, as Ashoka Buildcoin is in focus, where companies has received focus notice from the National Highway Authority of India after a grader collapse on the National Highway 66 project that caused a fatality and is temporarily barred from bidding for the next 1 month. So back of this news flow, Ashoka Buildcoin is under pressure and the stock is down 2 to 3%. Apart from this, another stock is under pressure, GAIL. Where PNGRB has announced a 12% hike in tariff for GAIL's integrated natural gas pipeline with effect from the January 2026. But GAIL is expecting a hike of 33%, and PNGRB has announced a hike of only 12%. So it was lesser than the expected of GAIL. So back of this news flow, GAIL is also under pressure. Reflex Industry is in action on the back of their order when a company has bagged an order of rupees 100 crore for the exhibitions loading and transportation of pond. As Bitcoin is also another stock that is in focus on the back of their order when a company has received a LOA from National Highway Authority of India for rupees 879 crore project of 4-laning of road in Tamil Nadu. Voltime Transformers is also in focus, where company has received a letter of intent from Gujarat Energy Transmission Corporation Limited, and the cost of the order is approximately 85 crore, and company has received this order for supply of various rating of power transformers. Lemon Tree is also in focus, where company has signed 2 new properties in Gujarat and Uttarakhand. And if we talk about the stock that are in action on the back of their brokerage note, Paytm is in focus, where Goldman Sachs has come out with a note and they have upgraded the stock to buy from the neutral rating and hike target price to rupees 1570 as compared to earlier target price of rupees 705. Goldman Sachs see more than 100% of upside in the Paytm, and they say that the regulatory environment is improving for the company, and they expect a recovery in payment market share and better earning visibility. And lastly, Privi Specialty Chemicals is also in focus, where Motilal Oswal has come out with the note, and they have initiated a coverage on the stock with buy rating and target price of rupees 3,960. They expect company to deliver a CAGR of 27%, 34%, 46% in revenue, EBITDA and PAT over FY25 to 28. So back of this bullish note from the Motilal Oswal, Privi Specialty is up approximately 3%.
GAIL that stock. Ravinder, thanks for taking us through all of those buzzers. Previous speciality on the back of Motilal Oswal buy initiation. Target price at 3,960. That stock is up about 4% as we speak. But let's shift focus and talk about the top loser on the Nifty 500 group of stocks, and that's GAIL. For the reason we told you about in terms of their tariff differential between what they had expected and what was allocated to them by PNGRB. Earlier in the day, we spoke with the management of GAIL, who said that the tariff order adds more than 1,100 crore to the company's net profit, even though it is much lesser than what they had anticipated. Let's go across and listen in to what the management had to tell us.
It's lower than what we are expecting, but the order itself says it's not a final tariff. It's an interim relief given to us, considering that two parameters which undergone significant change since the last tariff order was issued. One was system use gas, which, if you remember, PNGRB had considered a significantly lower gas price of $3.61 cents per MMBTU, even against even the domestic gas price was around $6.5 per MMBTU at that point of time. And second revision, we were expecting around capacity determination, which PNGRB had carried out. So the order says that the revision is on interim, considering these two factors only. There is nothing negative in terms of sentiment, because PNGRB in its order itself has said that they will consider and revise in from April 2028. Tariff revision certainly will increase our bottom line immediately by 1,200 crore rupees per annum. So therefore, there's just a positive. There is nothing which we say negative. You can say that we were expecting more, and immediately we are not getting as an interim relief we are getting, but we expect that also will be available very soon.
Okay, so that's the word coming in from the management of GAIL, and steep pressure on that stock, about 4.5% lower. But we have Kunal Bothra joining us in the studio. Kunal, hi, good afternoon. Very range bound, no momentum at all today on the Nifty after that fresh high yesterday. How are you reading the momentum that we've seen over the course of the day?
Yeah, this looks like a different Friday, because in the last two versions of Friday, the markets have been very, very volatile. Yesterday also the markets were a lot more volatile. So today I think everyone is waiting for that volatility to happen, but the markets are surprising them yet again. So no major cues as such from the markets, no major change in terms of the data points. It's still the very similar kind of a sector behavior where you're seeing banks, few of the NBFC names, L&T Finance, Shriram Finance, AB Capital, etc., which have been doing fairly well for themselves. There's been slight pickup in terms of the private sector banking names, which we saw in the first half at least, where you saw names like Kotak Bank come back to about 21-20 odd levels. You saw some recovery coming back into HDFC Bank, etc., on the large cap private sector banking names. And there was a mild recovery which came back into the likes of Bank of Baroda. So no major cues as such which has changed our stance from the indices. It's just that I think, as we anticipated yesterday also in the second half, that we are likely to go into a couple of days of consolidation for the Nifty over here, because of the kind of up move which we've already seen and the new highs being reached. That generally is a zone where traders would want to shift their stance from being call writers to put writers, and that's a phenomena which takes at least a couple of days in terms of adjustments.
Okay, and Kunal, amid a market like this, where are you seeing any value if at all? What stocks are looking good?
So in terms of recommendations, would go forward to buy calls. Pharma pack apparently is heading towards a breakout. The Nifty Pharma Index is on the verge of a classical swing breakout over here on the short-term charts. So from that pack, I would pick Aurobindo Pharma as one of the mid-cap bets over here. Would look out for 1270 as a target. Stop loss to be kept at 1220. SRF is the other stock which is also looking extremely attractive. The stock, after almost like a 200-250 point correction in the past one and a half odd month, is now seemingly showing signs of bottom formation over here. The stock is trying to come back above its key moving averages. The volumes, the price patterns today are a lot more robust for SRF. So would look out for 3,000 as a target, recommending a buy with stop loss at 28.55.
Okay, so that's the take coming in on, but stocks are looking good right now with a market that has largely been range bound ever since the get-go today. But the beginning of the month often marks key financial activities like salary credits, bill payments and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. And to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. As part of the campaign, we are observing the 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. On that note, we'll slip into a very short break and track the markets on the other side.
Back with closing trades right here in 80 now and still lying absolutely flat in trade. Quiet consolidation after taking that all-time high for both the Nifty and the sensex yesterday. 26,376 right now. The Nifty futures and M&M has been that one strong hand from the word go. 2% higher, 3750 plus levels for M&M. Other than that, some of the Adani names are holding out well. So Adani Enterprises, Adani Ports, both those names gaining over 1%. In fact, Adani Enterprises is almost notching a good 2% of a gain. SBI has had a strong, move today. That's holding up about almost 0.6% or so. And other than that, Reliance has petered down a little bit. TCS is flattened out. So is the case with HCL Technologies. And yes, lots under pressure as well, be it in SBI Life, Shriram Finance, BEL, Bajaj Finance, the big mover from yesterday, Axis, Interglobe Aviation, Trent and Bharti. These are all laggards as well. But Nirav Sheth joins in on the show right now to talk about what he's making of the market. Nirav, hi, afternoon. Great to have you on the show. Nirav, what's the way forward now that the all-time high has been done with? Do you think a few more days of consolidation up ahead, or do you think come January when the earnings kick in, one is bound to see more upside to the current markets?
So it's obvious that markets will make more new highs. Sometimes we just don't know the timelines to it, right? So every day when you get up in the morning, your GDP is slightly higher than what it was at a new all-time high. The profits are largely at an all-time high every day as we move forward. It's just that the markets don't try and move in a linear fashion. We had a reasonably good correlation, time correction, so as to say. And please appreciate the fact that we are one of the worst performers as far as the global markets are concerned, right? So some of your peers are up 60, 70% in dollar terms. You are virtually flat. And I think that, so both the things, that the earnings are catching up in Q3, Q4, and the valuations are looking far more reasonable. So good times ahead.
Okay, so that's your take on the market right now. Nirav, now that all-time high has been hit on the Nifty, should market participants or investors be looking at purely large caps as a safety net, or is there more value and a more run-up that you're seeing in the broader end of the market?
We've been generally more constructive on the broader markets, right? So if I look at the earnings for the narrow market or the Nifty, then we are still looking at somewhere in about 12 or 13%. The expectations are of 15% next year. While, and obviously you can't paint the same color all on a large broader market, but there are a lot of the sectors within the mid cap space, in the small cap sales where, the earnings are compounding at more than 25-30%. So India is a delight market if you are trying to work with a broad level of sectors and stuff like that. You got manufacturing, you got platform companies, you got this EMS companies. There is a whole solar chain over there. So to answer your question, the broader markets are looking appealing as well.
And then, of course, Nirav, there is the strong appetite in the primary market. I mean, one can't really crib about flows not coming in because all the flows, I guess, are getting diverted there. Sign of exuberance, you think, or it's just one should read it as the market broadening up?
See, I think if you look at, for example, if you look at Germany, right, that also a very typical market that, you got very, very small companies specializing in very few sectors, niche sectors. They're not globally scalable companies, but very strong in their respective sectors, niche sectors. I think there's something on similar lines is playing out in India, but obviously on a scale which is 10 times, 20 times larger, because that is the size of the economy, right? Are there pockets of exuberance? It is always the case, right? But we don't know, right? So you can't necessarily try and say that the markets are getting overvalued. I'm not a great believer of that. For example, we talk about the fact that there's an AI bubble. It's a very profound technology. Valuations can be ahead of the story. You can argue that. I hear about this narrative about Lenskart. No one puts a gun on your head and asks you to go and subscribe the shares, right? So it's a free market. There is supply, there is a demand. This is a very, very good thing for India. Access to many larger companies, and the fact that if you meet a lot of the promoters, which we do, there is a preference for equity over debt for whatever happened in the last 10 years. So yeah, there's money into the economy, and that's a very, very welcome trend.
Right, but Nirav, you did mention Lenskart, and I can't help but notice the kind of subscription that Lenskart saw versus the listing it saw. Compared to the IPO that listed today, I don't know if you've tracked Sudeep Pharma, 94 times oversubscription and also listed at a premium. Do you believe this ratio or the trade-off that we're seeing between subscription and the listing is justified the way the trend has been so far?
No, I'm not a great believer in that. I think if you're in the market, if you're a market participant for a long period of time, a lot of these GMPs are to some extent even they can be managed, especially for very smaller issues. And I'm not casting aspersions on anyone over there. But when you talk of very large cap market companies, you have to believe that there is a lot of efficiency in terms of how the issues are priced. This is essentially a demand supply situation. So I would not wager the opening pop-up that you get based on the level of subscription that you get. You need to have a sense of intrinsic value of the company at the end of the day.
Understood. But Nirav, any of the recent IPOs where you've recommended a subscribe?
No, I don't want to necessarily get into individual stocks, and not that I've studied. I'm just making a very, very generic comment. And I am a believer of the market efficiency. So I was just replying to the point that you made that, there seems to be an over exuberance in the IPO, and I don't necessarily buy that argument. So it's a very vibrant and healthy market, and that's very welcome. And I'm hoping that I'm not giving a biased view, because obviously we brokers benefit from the tailwind.
Okay, fair enough, Nirav. But let's just focus to the secondary market and once again talk about the biggest constituent or the sector that's done most of the heavy lifting in that all-time high that we've scaled yesterday, and that has to do largely with financials, both your banks and NBFCs. Are you seeing further run-up in this space, or do you believe that the exuberance here is over and now maybe we could be seeing strength in some other sectors?
No, so I believe that the current round of the market leadership in the Nifty will be taken by banks, because obviously you are coming off a cycle which is poor credit growth in the last year. You've seen fair amount of repo cuts. We believe that there'll be more repo rates to come, hopefully starting next week. And therefore, you will see revision in terms of the credit growth rate, in terms of NIMs, expectation in terms of earnings growth rate, and the valuations are very reasonable. Within that space, I still believe that NBFCs will lead the rally. They've been leaders of the rally so far, and largely because the growth differential between banks and NBFCs is large, and the divergence in ROE also seems to be narrowing. Most of the larger ones, you talk about Aditya Birla Capital, you could talk about Larsen Financials, they're doubling the book every 3 years, which is 25% CAGR, with an ROE about 15-16%. So that's great.
Right, and Nirav, speaking about rate cuts, what are you making of the GST cut that we've seen? Do you believe that it's about time for the impact to start playing out, if that's something we could see in Q3 itself, or will that take a little bit longer?
It's already played out in Q3, but don't try and think of this as an episodic 1 quarter sort of event. The fact of the matter is that for a lot of these sectors, you had a significant increase in the prices, running far ahead of the increase in per capita income. To that extent, there's been a balance between affordability and the prices right now. And therefore, for at least some of the sectors where you're far more optimistic is two-wheelers and stuff like cars, especially the lower end of the cars, we probably believe that you'll have a better volume outlook for the next several years. And I also want to make a point, and this is very unlike most of the world. In India, we just don't, we are not very keen in terms of taking price actions based on how the macro environment is playing out, right? You've seen enough. You go abroad, and Tesla, every time there's a slowdown, Tesla is willing to take a price cut and try affordability. Thankfully, government is playing the role over here, but that will change as we move forward.
Right. But Nirav, what about the entire consumption fillip or boost that the government has been, sort of pushing? Do you think that's going to translate materially into earnings and thereby then PE as well?
So on the discretionary side, I think it will matter into the earnings, because at least our belief is that the volume elasticity is more than the price cuts, right? So over a period of time, that is certainly an accretion to earnings going forward. If you're looking at, what you call the fast-moving consumer goods space, the benefits are far and few in between. But again, there are valuation concerns over there. So at least personally, I am not a big fan of trying to play the likes of, Nestle's and Hindustan Levers and Asian Paints of the world. I think that there will be long-term laggards in this bull market.
On the flip side, Nirav, how would you play the consumption space? Would it be via discretionary or would it be via autos? What would your play be here?
Yeah, very clearly autos. So I think you got penetration on your side. Now you've got the GST kicker that comes in. Very, very strong competitive mode for a lot of the companies, very well established niche that each of the guys are going to play. Quite like those space. I also like cement, for example. The stocks are not rallied at all, right? And I believe that cement is where telecom was 3 years back, and a lot of consolidation, inherent pricing power is there. None of them are going to do anything right now because you're in 1 or 2 quarters of these GST cuts. Wouldn't look good to try and take price increases, but they have to come if you take a year out. And therefore, those are opportunities, I would say.
Nirav, so great to have you on the show. Thank you so much for your time today.
Pleasure. Thank you.
Okay, on that note, let's take a very quick break. When we come back, we'll continue our market discussion with our other experts.
Back with closing trades and just talking about some macros. While we're awaiting that GDP and IIP number later today, we understand that the RBI is going to be holding a press conference at 5 p.m. later today. What we also understand that this could be on the consolidation of regulatory instructions, and RBI Deputy Governor Shirish Chandra Murmu is likely to address the press conference. So that's the RBI presser that's going to be taking place at 5 o'clock today. Remember, the GDP number comes out at 4 o'clock. So let's see if that has any mention, but unlikely in the RBI presser. But it's the last trading session of the month, a brand new series, and the markets are hoping for a Santa Claus rally in December. Now, seasonality trends point to a positive bias, with the Nifty delivering an average 1.5% return over the past decade and broader indices doing even better. Which sectors have traditionally outperformed and which have been the biggest laggards in the Decembers gone by? Ashesha is joining us with that analysis.
Well, yes, we are set to enter the last month of this calendar year, so we decided to take stock the kind of returns indices have given historically in the month of December. First up, let's put the spotlight on Nifty. It has given an average return of 1.5 times over the last 10 years. Broader markets, however, have performed rather better. Nifty mid-cap index average return stands at about 2%, and Nifty small-cap index return, meanwhile, stands at about 2.8%. So broader markets clearly have outperformed Nifty 50 on an average over the last 10 years. Let's also talk about the number of times Nifty has actually ended in the green. So Nifty has ended in the green 6 out of the last 10 times. Nifty mid-cap and small-cap at 10 times respectively. In terms of individual sectors, we have Nifty Metal Index, which has always bucked the trend. It has given an average return of about 4.2%. This is the highest amongst all sectors over the last 10 years. IT index at 3.6%, realty at 3.8%. We have auto, energy and pharma, which have given an average return of about 1.1 to 1.2% over the last 10 years. On the lower side, financials and banking sector, PSU banking stocks have not given as much returns as compared to other sectors in the month of December. So that's how sectors have performed in the month of December historically. Meanwhile, let's also put some other facts and figures in front of you. Nifty Metal Index is closed in the green at least 7 out of the last 10 times, and Nifty IT Index too has closed in the green at least 7 out of the last 10 times. So yes, on an average, December has been a good month. Index has given about 1.5, 1.7 times return. Nifty Mid and Small Cap Index have outperformed Nifty. Let's wait and watch how December 2025 actually turns out.
Okay, that's the December seasonality. Kunal, looking at the charts, what does it feel like? Does it seem like we're going to have another bout of a Santa Claus rally?
Yeah, I think it will happen, but I think it all depends now on the first week. So the first week on the Fed event as well as the RBI policy event, I think if all goes smooth, I would not say as per the market's expectations, but if there is no major volatility, then I believe that there could be a chance that we may see the dash towards the year end to be on the much more positive side. And I think if that happens, if these two data points, they don't deter the market, of course, then I believe we could be looking at the mid cap end of the markets being a lot more vibrant than the larger cap names. So I think that could be a dose of confidence which the markets would probably want to require at current levels, given the way we've struggled in terms of the market breadth over the last many days.
Okay, so that's the take on what could be the market texture going ahead. But we also have Mr. Rajesh Parve, head technical and derivative research at Axis Securities, joining us on the show. Rajesh, hi, good afternoon, and good to be speaking with you today. I don't know if you heard my colleague Ashresha highlighting this trend of how metals, IT and real estate have done well in December, but banks have not done necessarily very well. Do you think this December that trend could reverse, because IT continues to be strong, but banks too are showing some show of strength?
Good afternoon. So banking sector is clearly in uptrend, and I think the continuity of uptrend would be there in December series also for banking stocks. Also, as rollover data is also pointing out that long rollover has been shifted to this December series. So I think we may see continuity of banking stocks for December series also. Yes, we could witness some buying action in IT also. That sector is also showing sign of buying action from the lower level, and most of the IT stocks from lower level has shown some recovery. So I think yes, another sector where we could see some uptick is from the IT also. Some of the large cap IT stocks like Wipro, TCS are showing sign of buying interest. So accumulation activity is going on in these stocks. But yes, mid cap IT is looking one notch better from this space. So I think stock like Persistent, Coforge, LTI, Mindtree, all these stocks are showing the sign of strength on the near-term chart. So banking will continue, but IT can also show some uptick in December series, and I think a broader market may also showing a buying interest. So I think in the first half of December series, we believe that yes. This broader market may also perform well. So first half would be interesting for December month as the rollover data is also positive. Nifty is holding the breakout level. Short covering has already played out in last couple of days. So I think there is a possibility that we could see further more uptick in the broader market also.
Okay, so that's what's looking good in the market going ahead. Kunal, the metal index is something that has outperformed the breadth of the market in at least the last 10 years of December's going by. Do you think that trend that we've seen could continue this time around? Because over the last couple of weeks, metal stocks are doing very well. But even on a month-to-date basis in November gone by, metals look like they might close in the negative.
Yeah, but I think it's in their nature to be a little bit more volatile there as compared to the other sectors or traditional sectors which tend to get linked with the market movements. So we've seen metal stocks giving a beta of almost 1.5 to at times maybe even 2 with respect to the benchmark indices, which means that the volatility for the metal stocks is almost 50% more to maybe at times even 100% higher as compared to the benchmark indices. And if you look at the individual components, maybe the numbers could probably move up significantly higher in terms of the expected volatility. I think in the last maybe 6 months, 1 year of the price correction, we've seen multiple times that when these metal stocks go into a corrective phase, there comes a point where suddenly, all of a sudden, you see the selling pressure abate for these stocks. These stocks going to a zone of consolidation, the risk reward emerging positive, and then slowly and gradually trends pick up. I sense that could be a zone where traders could look at a contra buy for many of these metal names. So I would actually believe that we could be looking at a much stronger breakout for metal stocks, but then buying this at an opportune time, I think, is a better strategy rather than participating on the higher side in terms of momentum, which could fickle out and which could reverse in a very quick manner on the short-term charts.
Okay, it's important to reiterate what the Commerce Secretary just said, and if we can just bring up those graphics again for you, because he made some comments on the India-US trade deal. Remember, that continues to be a big overhang, and especially from an FI investment perspective as well. He's saying that commitment to see the first tranche is going to complete by fall of 2025, witnessing a lot of changes in global trade landscape right now, talking about as to how they've engaged with the US for a BTA, and negotiations related to reciprocal tariffs are still on, witnessing a lot of changes in the global trade landscape right now. And the framework trade deal will come first, tried to iron out most issues. So a step in the right direction for sure. At least that's the word coming in from the Commerce Secretary. Also saying that we'll decide on the right zone or timing to announce the deal. The trade agreements are wide-ranging agreements, saying that they're optimistic about finding a solution within this calendar year itself. So that literally leaves just 1 month on the table, and especially before US heads out for Christmas break. And the call to be taken at multiple levels, including a political stance. So leaving some room for negotiation still on the table. There are areas which are non-negotiable for India, will be beneficial, both reciprocal and oil-related. Tariffs get addressed, and that talks are currently on. Teams are engaging virtually every week. So pretty much stating that work is going on by the hour when it comes to the India-US trade deal. But there's important data and GDP like we flagged off as well. So let me take it across to Mithali and find out what is it that we're anticipating from the Q2 numbers this time.
Right, so India's economy is expected to post another quarter of strong growth. So ahead of the official release later today, economists are forecasting 7.3% of GDP growth for Q2 FY26, signaling continued momentum amid the global uncertainties prevailing. Now, the Reserve Bank of India has projected 7%, while the brokerage's estimate came in at a slightly higher range between 6 to 8.5%. The strong performance is mainly driven by the rural demand, also due to better agricultural output, better monsoon, and easing inflation around. Now, the growth in agriculture, manufacturing and construction, along with higher government capital spending, also supported the economy this quarter. However, the private investment remained weak as companies are still hesitant to expand and also spend amid the global uncertainties. In recent quarters, India grew 7.8% in Q1 and 7.4% in the last quarter of FY25, making it one of the fastest growing economies in the world. But economists warn that the growth may slow down slightly in the coming quarters, with around 6.8% and 6.3% of growth due to the global headwinds and also the investor outflow seen from the foreign institutions. But as of now, India's Q2 numbers look quite solid. The economy is set to deliver another strong 7% plus of performance.
Back with closing trades right here on 18 now, and still pretty quiet in the session. The European markets have opened and they too are just ambling around within the red to the green. Pretty quiet a session there as well after a quiet handover from Asia. For us as well, it's been pretty quiet a day. The Nifty just been very, very sideways today as was predicted. But the breadth of the market, that was the case yesterday too and today as well, that's been lingering in the red, at least within the F&O pool. Right now also, if I look at it, a good 130 stocks are standing to the decline. And even within the Nifty, the composition is tilted more towards the red as opposed to the winners, which are far and few. Kunal, is that a trend that could continue, that perhaps the underperformance of mid and small caps vis-a-vis what the large caps would do could be a little bit more stark for the days to come?
Yeah, it could be a little bit more stark. So, it always, we say that things get worse before it gets better. So, I think we're still in that pain point where the markets are moving apart. There's a sense of optimism when you look at the indices that the Nifty scaled back to new highs. But then, portfolios, across the board have been, showing negative returns as such because of the way mid caps have behaved. And, this pain generally, comes to a point where things extend towards, an extreme before they come back into normalcy as such. And, so far, what we've also seen is that many of the mid caps and small cap, stocks are still going into that phase of correction. There are many stocks which are still making 52-week lows, even on a day like yesterday and today, where you see stocks, selling down under the back of higher volumes. So that, I believe, is a concerning point. For the market breadth to reverse, you need many things to happen. You need the market, the number of stocks which are making new lows, that has to reduce drastically. At the same time, you need to see volume patterns emerging. That generally happens once confidence seeps into the market. That, I believe, could be some bit of more time, maybe another couple of weeks or another couple of months at least.
That's the market outlook going ahead. But before the break, we were talking about the comments trickling in from the Commerce Secretary on the timeline and the work that's already happened on the first tranche of the India-US BTA. Let's go across and listen into what more he had to say. That's the word coming in from the Commerce Secretary, Rajesh Agarwal.
Trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella, but at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on, but one will feed into the other. What needs to come first is the framework trade deal, which is able to address the reciprocal tariffs. We have engaged on it for last few months very deeply with the US teams, and I think all I can say that we are close. We have tried to iron out most of the issues. Now it is only matter of time when this decision has to be taken, that when the two countries have to find the right landing zone to announce the deal.
Okay, that's the word coming in from Commerce Secretary Rajesh Agarwal, sounding very optimistic on the timeline at which the US-India trade deal right now, the first tranche of it at least, is being ironed out. But let's pivot to the markets once again. And Rajesh, amid a market like this, on a BTST basis, which stocks are looking good to you?
So, GMR Airport is really an uptrend, and the way stock managed to give breakout above 100, 105 level, I think this stock has potential to extend its gain. Now stock is negotiating with its previous swing high of August 2024. So I think on a long-term chart, the stock is now managed to give breakout. So we believe that 114 to 116 would be the next target for GMR Airport. On the downside, one needs to keep a stop loss around 104. The other stock where we are focusing is from the banking basket, and that's Federal Bank. Clear uptrend. Stock is making higher top, higher bottom formation. Stock is enjoying its all-time high trajectory. So outperformance is likely to be there in Federal Bank. We are projecting target of 266 to 268. On the downside, 253 needs to keep as a stop loss.
That's the case coming in on some of the banking names. Just looking at some of the losers, and Gail, we should bring up that soundbite as well, because that's managed to cover some amount of that gap down that it sitting at earlier today when it opened for trade. Having said that, it's still a good 4% lower as we speak right now, although lifted off from the session lows. MCX, the star performer, hit a life high, and today it's down about almost 4.5%. That's the case with IEX, with Suzlon and SBI Life as well. Rajesh, your reading on the charts of some of these mega movers and MCX and even L&T Finance?
So overall, structure for MCX is on the bullish side. Yes, there was some profit taking at higher level, but still, if I analyze on the near term chart, also stock is holding the strength on the near term chart also, despite this corrective move. On the downside, till stock is trading above 9900 level, I think trend is likely to remain on the bullish side. So 9990 needs to keep as a stop loss. Till these levels are intact, I think some pullback action we may witness going forward. But again, on the pullback, 10,200 would be the first supply zone. If it crosses, then I think furthermore upside we can see for MCX in the near term as well as on the short term perspective. LT L&T Finance is also in uptrend. Series of higher top, higher bottom formation is taking place. Comfortably, stock is holding about to all its near term, short term support area. So looking at this mild profit taking, I think even if you get opportunity around 305, 300 level would be again, good level to re-enter in this counter. And we believe that, continuity of uptrend would be there, and 330 to 340 would be the next upward target we could see for L&T Finance also.
Okay, so those are some of the stocks that have made it to Rajesh's radar this afternoon. But on that note, we'll step into a very short break. And on the other side, we'll talk more about the market fundamentals and track the last 30 minutes of trade.
Back with closing trades right here on ET Now, holding out flat as we speak right now. Well, of course, there are names like M&M, the Adani group of stocks. They're the ones which are holding out. But that's not quite the case with some of the insurance plays, BEL, Axis Bank, L&T, Bharti, and some of the FMCG plays as well. That's where you're seeing some amount of pressure. SBI, though, has picked up a little bit, as has Sun Pharma. And then Unilever, DRL, Kotak Bank are also names which are also looking up right now in trade. And for the Nifty, it continues to be absolutely flat. But since Sunil Subramaniam as well joins in on the show right now. Sunil, hi, great to have you on the show. I think the debate is more about where's the safety next now that we've conquered that all-time high. And do you stick by with the large caps, or do you diversify some into mid and small caps as well?
Well, I will diversify some into mid and small cap because I think what's going to happen is I think that the gradual return of the FI is happening in a very slow pace, but a trade deal announcement could make that gather pace. The second reason I expect FI's buying to pick up is because this is the period between now and end December is when hedge funds book profits. Now, obviously, they book profits in markets where they made profits, and India is not one of those. So I think our competing markets like China, Taiwan, South Korea are the ones which give them very good returns within the Asia emerging market pack, and hence there will be profit booking there. And India stands a decent chance of getting a portion of the fresh allocation because we haven't run up, right? And if you see the outlook, this quarter has been a indicator. It's been a tough quarter, but it's shown clearly that the second half can be better than the first. And for next year too, most brokerage houses are predicting at least a 14% to 15% EPS growth for the Nifty, which is a large cap. So while FII, I expect them to gradually start allocating more to India, though we are still not cheap from a valuation perspective. DII's behavior will be to sell the large caps into the FIIs and reallocate to mid and small caps in a greater way. And why do I say this is because there's been a huge run up. If you look over the last 1 year, I like to look at the 1 year data because there's a sharp polarization, and in the 1 year, it's been the DIIs who have driven the market. So they've had some favorite sectors and they've had some sectors they didn't like. So what have they liked? They've liked PSU banks, they've liked defense, they've liked the capital markets theme, they've liked auto because of the GST cut, and then to some extent some metals, right? So these are the ones which have driven the market to wherever it was because a small FII return made it touch lifetime highs. But what have they not bought? They have not bought IT, which is a big underperformer. They have not bought realty, again a big underperformer. FMCG they haven't bought. So the point is that I'm saying is that given the relative valuations now because of the strong divergence in performance between the top sectors and the bottom sectors, I think there will be a reallocation by DIS. So when the FIS come back, they will sell back those which have booked profits. So markets will then remain in a consolidating zone with an upward bias. But at the same time, right, I think this is a crucial period when you can't expect a strong direction unless the trade deal happens, because FII flows will be at the margin tending to positive, but not a big flow. So to me, then I see that this is a good time to reallocate from a pure large cap. I mean, if you look at it between large cap and mid cap, there's not been much difference in the 1 year returns. No? I think Nifty 50 is about 9 odd percent and the mid cap index is about 8 odd. It's a small cap which has really suffered because it's down about 3.5% on a 1 year basis. So which means it's almost a 12-13% underperformer. So I think the part of the reason for that, if I may also add, is the fact that earnings season wise, like large cap delivered according to estimates and expectations, high single digits. Mid cap did 34%, which was pretty decent. Small caps, though they grew about 18%, were underperforming relative to expectations because the valuations are obviously 30 plus 1 year forward P. So I think that disappointment is there. But in the next half year, I think the growth pickup will happen across small and mid caps, and the next quarter's earnings will support that. And in the consumption pack, it's only auto which has helped the consumption deliver some returns. So realty, which is a part of the consumption pack, has underperformed. FMCG has underperformed. So now and consumer durables also hasn't done as well except for the auto side. So you will see in the summer, you will see the cooling related refrigerators pick up. You will see that affordable housing will come through as the year goes by, and you will see a pickup in the real estate. So these underperforming sectors is where I see DIS now reallocating, and hence my favorite category at now would be the multi-cap category, because it has to compulsory allocate 25% to each to mid, small and large. And so that's the safety zone to answer your question.
Seems to be the key, Mr. Subramaniam. You did speak about reallocation from the DIIs to the FIIs from two large caps now and their foray into SMIDs. But within the SMIDs basket, talk to us about which sectors could see strength going ahead. You did speak to us about some of your favorite sectors, but what are some underlying themes that you believe are underplayed now and have more potential?
So I think that the biggest theme which is underplayed is the private capex cycle. And the reason I am so bullish on the private capex cycle after so many years of disappointment on that side is because this whole GST cut consumption boom, you've seen it in the auto space, you see it in part of the consumer durables, you'll see that the rest of consumer durables as the year goes by, is the rise in the revenue, that is the top lines. I think it's the bottom lines which people are not sure whether the margins have been affected or not. But I think that it's reasonably guaranteed that all the consumption companies are going to see good top line growth, which means capacity utilization in the country will rise up from the 76-77% that has been stuck in for such a long time and will probably cross 80% in the next year. So when that happens, that's the trigger. If you see the history between 2008, 9, 10, 11, when capacity utilization crossed 80% is when private capex picked up. So I see that happening next year, and so that's not fully priced in. So for me, it's the entire infra pack, but with special attention to industrials, because private capex is different from government. Government capex largely relies on the building side of it, which is cement and steel and building materials and all of that. But industrial capex, which is the expansion of machinery and plant and machinery, that's the segment which I believe will lead the next leg of the medium term rally. And I feel that's not still fully priced in. So the broader infra pack, whatever comes in, and that's the same reason I'm bullish on PSU banks too, because they finance the MSMEs and the SMEs there. The only thing is, it's been the best performer over the last year. So to expect again another 25% return is probably, it'll still deliver healthy double-digit returns over the medium term. So though PSU banks are not undervalued by any means from a last year's performance perspective, relative to private sector banks, they're still at a price to book discount. So to me, that's the two spaces which I believe there is potential for the market to grow in. You asked me about relative valuations. And of course, the tariff impacted sectors, right? As and when a deal gets announced, and what you played about Mr. Agarwal's talk about it, looks like the deal is around the corner. Then all these tariff sectors which have been beaten down, textiles, leather exports, to some extent pharma. And IT has had this huge negative overhang on it, though it's not directly tariff impacted. So all of those also represent potential value buying opportunities for me. But the amount that you allocate to those, because it's a very big digital world, what do you mean that? Either it's one or zero, right? Either the deal goes through quickly or it doesn't and keeps getting stretched. So that's a risk there. So right now, I would still allocate about 25-30% to those tariff impacted or export oriented sectors and still keep my 75% around a domestic focused story around the industrials, the capex cycle, and the public sector banks.
It's okay. Hold on to that thought, Sunil. We're just going to get back to you and get in your opinion on the rest of the market too. But two stocks in focus, that's Paytm and Lenskart. Paytm is pretty upbeat in trade. Goldman Sachs, in fact, has assigned a target of 1570 and it's retained its buy on the stock. Let me take it across to Mithali and address that first.
Right, we see that Paytm has been buzzing since morning after Goldman Sachs upgraded the company's rating to buy from the earlier stance of neutral. Also, the company's target price has been raised to 1570 rupees from the earlier target price of 705 rupees, implying a 21% of upside from the current levels. It also sees a skewed risk reward with up to 79% upside in the sky blue scenario. Now, in the latest report, Goldman Sachs noted that easing regulatory pressures has helped drive early signs of recovery in the company's payments market share, also seeing boosted earnings visibility for the company. The firm also highlighted that the relaunch of key products, including their postpaid services and potentially wallets, which could support 20% plus of revenue growth over the next several years for the company. Now, strong cost control and a rising contribution seen around from the high margin financial services are expected to more than double Paytm's EBITDA margins in the coming 3 to 4 years. According to Goldman Sachs, further recovery in MTUs, growth in the lending business and new product launches would also add up to the value of the stock. So Paytm shares react positively on this note and has been seen buzzing around in green since morning.
Okay, Mithali, thanks for that. So yes, Paytm doing very well on a buy upgrade coming in from Goldman from their neutral rating earlier, and the target price hike that has been quite steep too. The other stock that has been in focus since the get-go today on the back of brokerages is Lenskart. Simmered down from the day's high where it was trading as high as 4% today, but has simmered down steeply from that high. Nonetheless, it's Jefferies' initiation of their coverage coming in on Lenskart with a buy rating. Target price at 500 rupees per share, which is about 22% higher from where the stock is trading currently. They believe that Lenskart is India's largest tech-driven eyewear provider, and despite that, it holds only 5%. Pardon me, 5% market share in the Indian market. The Indian market alone for Lenskart can contribute to more than 85% of its total EBITDA. On the back of these two factors, they believe that Lenskart has a huge growth runway when it comes to the Indian market, and also the international segment offers optionality and diversification to their revenues as well. Attractive unit economics are at play over here. Fast paybacks for them should drive about 50% of their adjusted EBITDA CAGR over FY25 to FY28. EPS is expected to grow at a very healthy 44% CAGR. Balance sheet is net cash. Return ratios are looking good. Their free cash flow is solid right now. So Jefferies is valuing the stock as 50 times FY28 EBITDA, which they see as attractive. And on the back of that, that buy initiation from Jefferies on Lenskart with a target price of 500 rupees per share, the stock has simmered down. It's not doing all that much. But well, it's going to be an exciting weekend for everybody who really likes to shop, and it's a Black Friday. That is in full swing as of now because shoppers have geared up to add to bulk up their bags with stacked discounts, bank offers and exchange bonuses. It's expected to be a bumper day and a bumper weekend across sectors like electronics, apparel, beauty and more. Anjali Palod is standing by at Phoenix Mills to get us a mood check of the shopping frenzy today.
मैं right, so we are here at Phoenix Palladium in Lower Parel, Mumbai, where the buzz for the Black Friday sale is clearly being seen. It's still early hours of the mall opening, but we've seen a lot of footfall. A bunch of brands are participating in the Black Friday sale, barring a few ultra luxury ones. We can see most of the stores here, international brands even participating in the Black Friday sale, giving deals up to 60-70% off. Now, the Black Friday sale has become a big retail event in the past few years, coming from the West, originating in the US. After Thanksgiving, this is the weekend where US shoppers go all, and that trend has now come into India, where we are seeing a lot of participation from online platforms, e-commerce platforms as well, but the buzz can be felt the most in malls. Now, Phoenix Palladium especially has extended their operating hours and will be operational till midnight these 3 days, starting from today till Sunday. But as you can see behind me, there are sales going on up to 50-60% off, and there's a lot of buzz. People are coming in early in the morning to grab the best deals that they can find. A lot of people that I'm seeing here are carrying bags, already done with their purchases, and try to explore more. So the buzz can be seen across all categories. There is beauty, footwear, clothing, lifestyle, all sorts of brands have discounts going on over here. And as the day progresses, and in fact as the weekend comes up, the malls are expecting much more footfall as well.
Well, wondering if around 12 noon is when Anjali went, and if that is what the stores at some of the Mumbai malls look like, I wonder what's going to happen towards the weekend. But yes, more money in the hands of consumers. So I think this will be a big litmus test as to whether this all converts into sales or not. But Sunil, what is your sense of discretionary consumption? When do you think that will meaningfully come back and reflect into earnings?
No, I think that discretionary consumption as a top line, I think, is beginning to come back. Reflecting on earnings, I think actually because of the stock piling up, because it hasn't done well pre-GST for such a long time, I think there is the tendency to offer greater discounts and get the stocks off the shelves, right? So I don't really expect a huge margin boost coming in the January quarter when you look at these numbers. But what's good is that a lot of their stock will move out. And these are high operating leveraged companies, right? So because of which you will see that while their margins may be compressing, on a bottom line basis, it will again help because their fixed cost gets covered that much because they just need to get past the break-even point. So overall, right, when you look at purely from a margin perspective, I do think that they will be a little bit under pressure because of the competition and the need to get rid of old stocks. But EPS growth and the fact that they will now be well positioned to manufacture new products. And like I pointed out again, to me, the real story of discretion is going to lead into the private capex because sales numbers, that is revenues, are definitely going to be really hitting through the roof because of the GST cut, festival season, and the fact that the youth are very now tuned to American things like the Black Friday and all of that.
As we run up to the union budget, it's time for an 18 Now budget exclusive. Sources tell your channel that the government is reviewing its capex targets with ministries and departments ahead of the union budget. My colleague Prakash is here with more exclusive details on this. Prakash.
Well, that's an important development coming in as we are learning from our sources that the government is reviewing the capital expenditure targets with ministries, departments ahead of the Union Budget 2027. A comprehensive review underway to finalize capex targets for financial year 2027. And most importantly, as sources suggest that the government is likely to increase capex targets by 15 to 20% for FY27. In fact, the Finance Ministry is also looking for new capex drivers to spur demand in the economy. Potential capacity of key sectors also being examined. In fact, the government capex may be expanded to new segments such as urban infrastructure and sunrise sectors. Along with that, ministries like railways, road transport and highways, ports and shipbuildings have been major growth driver for capex. If you look at the data, current data, the centre's total capex for the first half of FY26 stood at approx 53% of the budget estimate, and the central government is hopeful of achieving 11.21 lakh crore capex target set for FY26. Along with that, sources also indicate that the Finance Ministry is likely to review state capex spending status for FY26 next month, which stands at approx 34% of budget estimate during the first half of FY26. A very crucial development coming in, and we are expecting slightly higher capital expenditure target for FY27. Back to you.
Okay, Prakash, thanks for taking us through all of those details. Mr. Subramaniam, weigh in here in terms of where the government capex is headed now that we're pivoting our focus more towards a consumption-based economy, and we were talking about consumption before this. Where do you think, or rather, what do you think the role of private and government capex could be ahead of the budget, and any announcement, estimate if you have on that figure?
Flat on the government capex part, it was 11 lakh crores. The reason is I think the government has realized over the last couple of years, especially, that government capex is not leading to the adequate amount of jobs, adequate amount of money in the hands of the middle class. So they have shifted to a consumption orientation, both through the income tax cut that they did in the last budget and the GST cuts. So this new thinking of the government is likely to go through because they have realized that the capacity utilization in the country, right, has to be driven up, and that can be done through consumption. And once that happens, private capex will get its energy and then replace that. So I think the government last year got the mix right in their minds in terms of saying, okay, capex is a focus, but let's keep it stable, but let's increase increasing amount of money to what I would call as developmental populism, right? Where you give the money, but that again goes back into supporting development in a way through the capacity utilization happening. So I think that this budget will strengthen that. So you might see a lot of incentives for private sector capex to pick up. I don't know in what form, in terms of tax breaks or maybe a renewed PLI scheme. So I expect that the government this time will focus its energies on sustaining its capex at the current levels, giving a boost to private capex, and giving a boost to private consumption. That's a new mantra I think that they will follow. And as far as the capex story is concerned, so private sector will have to take a larger burden of doing the capex part in the country. Also, they will try to help the states because I think central government has generally been proactive, but the states probably are the ones lagging. And one final point on the capex, I think this has been talked about in the past, but it has not come through, is the public-private partnerships on the capex. Because as you know, a lot of the PSUs sit on a lot of land, they have a lot of resources at their story, but they just don't have the whatever you call the aggression and the ability to think long term in their businesses to really take advantage. So public-private partnership where the public sector gives its land as part of its equity contribution and private sector takes that up and goes forward, I think could be a big story in this budget if it clicks. So PPP, I think, will be the buzzword in this budget, hopefully.
Okay, fingers crossed on that. Let's just take stock of how we are winding up for the day and the week, in fact. Let's just bring up the over-the-week charts as well for the Nifty and how we've managed to perform. It's been a historical week in that sense. We finally made it to that all-time high and we are comfortably above that mark, but closing in around the 26,380 odd level for the Nifty futures. And for the week, we managed to put on about 0.5% in the green. The Nifty Bank as well had an all-time high, as did the sensex. So important to mark those indexes as well. For the Nifty Bank, it's been a solid move. While the start of the week was relatively quietish, and then midweek we picked up and we finally closed in with almost a 2% gain for the week. For the sensex, it's been a 0.5% gain. Some of the other gainers, let's see what the IT index, what the auto index have been up to, because they also have had their fair share of contribution, as have financials too. The Nifty IT index pretty much in tandem with the banking index, 1.5% higher for that particular index as well. Auto is about a 1% kind of gain is what they've seen. And Nifty Finance as well has managed to eke out over a 1% gain. Kunal, do you think in the days to come, the sectoral composition would be the same? IT banks, are they likely to lead?
No, I think I think banks will be the one which could lead from here on. There is a strong rally which is coming back into the auto names. That's a strong sector which I believe could probably come back into a much more stronger breakout, because there are many candidates within the auto pack which are still looking very strong. There was a strong pickup of price action in the infra index. That's another index which I would believe could probably pick up pace, because as we see the markets getting a little bit more broad based than what it was maybe a couple of weeks back, then you're bound to see some new addition in terms of sectors which could make a comeback. IT, I believe that the initial part of the move has happened. You could probably expect that many of these stocks may now go into maybe a week or a couple of weeks of consolidation before they gather momentum yet again. So I think for someone who's looking to buy IT, I would wait out for now maybe a couple of weeks or at least a 3 to 5% swing on the downside to try and maybe add or accumulate more.
Okay, that's on the outlook for IT. But Kunal, what about some other sectors that have not participated in the rally that we've seen this month? And those are names like realty. Pharma has done pretty okay, but not all that great. Do you think it's time for some of these indexes to start picking up some steam, or still some consolidation underway?
Yeah, specifically on pharma, I'm very bullish now because I think for the first time, I think the last many months, we are starting to see the large cap pharma names making a comeback. Over the last couple of days, I've been highlighting Sun Pharma as one of the picks because the stock managed to not just break past about the 1800 levels, but there's a golden crossover which has happened for Sun Pharma. That generally is a technical indicator which we look out for when the stocks are restarting or resetting a longer term trend for themselves, where the 50 DMA crosses above the 200 moving averages. We've also seen that happening for the likes of Lupin, where the stock has recovered from its last 1 month swing lows. The likes of Aurobindo Pharma, which has recovered I think around 10% or 15% from its swing lows around 1040-50 levels, and then Glenmark, etc. So there are many pharma names which are making a comeback. What I like about the pharma index is large cap names like Sun Pharma, which are looking very strong. So which means that the leader from the entire pharma sector has started to show signs and now is on the verge of a big breakout for itself. That I believe could probably lead the entire pharma index. And also, I think when you look at this in the Nifty Pharma Index, on the charts of the Nifty Pharma Index, we are now coming back towards almost like a 10-month or 11-month breakout on the pharma index in terms of weekly closing. So that also I believe could be another positive for the pharma index. That I believe could be the other sector. Realty could take some bit of more time. I think maybe another week or so for the real estate stocks because the momentum seems to be missing out into these names. Maybe I think if there's some kind of a news flow which happens into the real estate stocks, that's where I would believe that you'll start to see momentum coming back. DLF, Godrej Properties, Oberoi Realty, these stocks have come back into a corrective phase, but maybe I think the bottoming out is still yet to happen for the sector.
Okay, that's the take coming in on the realty names and what the sectoral composition of the markets is likely to be moving on from here. But Sunil, within the entire discretionary pack, any particular sectors or stocks that you're liking?
I think that's time to start focusing on the cooling related durables because they have not really participated in the GST cut driven top line rally. And as the summer months approach now, I think that they will now play out the story strongly. So it's a good time to start accumulating those set of companies which are focused on the cooling area of consumer durables. The second is I still remain with a slightly longer term view bullish on the realty pack because the reason that the GST cut hasn't played out in the realty is because they're still focused on the demand side on the high-end properties. But I think the real story which is going to be developing is the affordable housing part, where there's a supply issue because none of these developers have focused on planning projects out in the affordable housing space up to now. I see that gradually changing over the next few months. And with the drop in interest rates and RBI probably hopefully cutting rates again, the EMI leverage impact on the real estate loans, home loans, is the biggest impact. So I think that will definitely play out next year. So again, as a contra pick, I know the technicals are saying that there's still some more downside, like Kunal was saying, but as a staggered manner within the overall discretionary consumption, I would favor the real estate also with a slightly longer term outlook.
On that note, appreciate you joining us today, Mr. Subramaniam. On that note, we'll let you go. Thanks for your time. Okay, viewers, with that, only about 3 odd minutes left for the market to wrap down for the day, for the week and for the month. So let's start zooming in on first what this month has shaped up to be. Yes, the first all-time high, fresh one for the Nifty this time around. We've crossed the 26,300 mark this month. You have the mid-cap that's crossed 61,000 for the first time. The small cap has underperformed the Nifty index. Now talking about the weekly move, it's been a good week for pharma, IT, autos and banks. However, you've had realty and public sector enterprises, metals and energy in the negative. But with that, let's focus what today's trading session has panned out to be, absolutely flat and range bound. In fact, we are struggling to hold on to that 26,200 mark. So let's see in the next 2.5 minutes if we're able to close above that. Flat move for sensex as well. Nifty banked to very flat move with barely a hint of a positive bias, but above 59,750 or around that mark rather right now. Some of the top gainers today, M&M has been doing wonderfully since the market opened today, 2.25% uptick over there. Sun Pharma, Adani Enterprises, Dr. Reddy's, Kotak Bank. So it's actually been a mix of sectors that have participated in the Nifty move or lack thereof today, because you have pressure on SBI Life, HDFC Life, Shriram Finance, Power Grid. Some of the top gainers of yesterday have seen some profit taking today. Sectorally, it's been a day of the auto stocks led by M&M, of course, but you have Exide, Eicher, Bajaj Auto, TVS Motor that have done well. Nifty Pharma, Media, Metal, FMCG, PSU banks are closing in the green, but some pressure on Nifty Energy on the back of the cuts we've seen in GAIL today, Nifty Realty, Nifty Financial Services and IT closing in the red for the day. Sectorally or individual stocks rather, if you take a look at some of them, Welspun Living is up 11.5%, solid rally on the back of some healthy volumes for that one. Newland Labs, Motilal Oswal, Poonawalla FinCorp, Ipca Laboratories, Force Motor, SRF, Varun Beverages, all of them seeing gains of anywhere between 3 and 4%. On the flip side, pressure once again on transformers and rectifiers. It's been quite a volatile week for this one. GAIL has, yes, improved from the day's low, but nonetheless a 4% cut on that one. Also want to see what Ashoka Buildcon is doing and how that has closed for the day, because it opened with a significant gap down. And like GAIL, has it recovered from the day's low? Nominally, a 3.5% cut for Ashoka Buildcon as well. Sirma SGS, MCX, Jyoti CNC, Akzo Nobel, GMDC, Railtel are some of your top losers today, with cuts ranging between 2.5% and 4%. So that is how we're shutting shop for today. But once again, taking a look at the advanced decline ratio, quite in the favor of the declines, but actually quite even Steven, if you could call it that. Both on the NSE and BSE, the advanced decline ratio is evenly distributed. And that India VIX cool off that we saw about till half an hour ago, it was about a 3.5 to 4% cool off. That has spiked up. Still lower by 1.5%, but a spike up from the day's low in the India VIX as well, and around 11.6 is where we are. So this is how we're shutting shop for the day, for the week and the month. Remember, this has been a week of the Nifty all-time high, and we have consolidated slightly after that. Seems like we've closed above 26,200, but we'll give that rate some time to settle. But Kunal, your final reading on the market and what is the new series going to look like? We've just spoken about the December seasonality. Where do you think markets might open on Monday?
See, I think we are looking at the point where it's been 3 consecutive months for the Nifty to which has recovered from 24,500 to now 26,200 level that we've closed, and it's been stable 3 months at least for the benchmark indices. Of course, the market breadth is something which is a point of concern. But then I believe slowly and steadily, once confidence, news flow, etc. seeps in on the positive side, you'll see the market breadth opening up eventually. So I believe that the December month could probably be a point where we may see that that start happening, where the market breadth becomes a lot more positive. And even in the last many days, if you look at the net market breadth, the net market breadth is the most classical indicator which has worked very well in terms of anticipating how the Nifty could probably have behaved. Yesterday the net market breadth was extremely positive, and we saw the index moving up hard to new highs, 26,200 plus levels. And today, when the market breadth was absolutely flat, 1:1 advanced decline, you've seen the Nifty being more range bound in a very tight kind of a band. So I think what matters over here now for the Nifty to gain more traction, more momentum, is we require support from the not just a few select large cap names or few select sectors, but across the board in terms of mid caps and tier 2 large caps.
Okay, on that note, let's wind it up right here in this edition of Closing Trades. It's a goodbye from Snehi and me.